Good evening and thank you for joining me for the new tax law class. 20 plus questions every person, family, and business must answer soon. My name is Stephen Van Metre. I'm a certified financial planner and the host of tonight's class. Tonight we're here to discuss how the largest and most anticipated tax reform act passed by Congress since 1986 and how it will affect you. Tonight's class will run approximately 60 minutes, and if you run into technical issues, well, that happens sometimes on these lives, so be sure to refresh your browser. And if you're worried about missing out on anything, well, not to worry. I've enabled the rewind feature so you can back up and catch anything you missed, and I'll keep a replay up for about 48 hours afterwards so you can watch the class as many times as you like. The content of this presentation is provided as educational information only, is not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or to participate in any particular trading strategy. The opinions expressed in this presentation or that of my own do not reflect the view of Atlas Financial Advisors Inc. or Stephen Van Metre Financial. Now, today's topic is about the new tax rules. I think tax education is important because paying taxes for government services is a core organizing principle of our society. It doesn't need to be shrouded in mystery, even though it often is. So that's why my goal today is to inform you about the wide range of changes to the new tax code so you have enough information to start seeking assistance on what all of these changes mean to you and your own tax strategy. Taxes can seem complex and jargon-filled, even though the underlying concepts are fairly straightforward. So let's take a second to explain how this workshop will unfold. The presentation is organized into 4 keys that I'll introduce to you in a second. Each key has between 2 and 7 specific tax rule changes to explore. Sometimes I'll give you a broad headline about the new rule before we look at the specifics of the tax changes. Where needed, we'll look more deeply at the details and offer some insights regarding the implications of any new rule. And then we'll finish with a clear statement of questions you might want to ask yourself about the new tax rule. Now, everyone's tax situation is different, so please make time to discuss your taxes with your accountant. Everyone's situation is unique, and I want to make sure you understand how the changes will impact you, your family, and if relevant, your business. So let me give you some pro tips on how to navigate this class. So have a sheet of paper handy and a pen and take some notes. So as we go through the different sections, if you find one that applies to you or you think, well, that may apply to me or it has applied to me in the past, take some notes about it, because what you'll want to do is when you sit down with your CPA or tax preparer, you want to have a line item list of things to go over to make sure that you're getting everything that you can when you file under these new tax rules. Now, if you have questions for me, just so you are aware, I am not a CPA or a tax preparer by profession. So if you do end up having questions for me, we have found that it's very difficult to take questions during these lives. So if you can, please email me or send me a Facebook message and I'll give you all my contact information at the end. So tonight's class will help you identify important questions you'll need to answer as you take up the challenge of understanding what the new tax rules mean to you. So to start the presentation, here's a few overarching questions to consider as we move along learning the new rules. These are the essential questions we hope to answer tonight. How will these laws affect me? Will these laws cost me money or will I benefit? How can I position myself to benefit even more? What do I need to change now and in the future? And what do I need to worry about? The key thing to remember is that with big tax change such as this one, you'll want to sit down and review your specific situation so you can be sure that going forward, you've optimized your approach so you're getting the most favorable tax treatment possible. Any new law, particularly one as far-reaching as this one, will provide many planning challenges and opportunities for years to come. So let's start at a high level with a few observations about the new Tax Act, formerly titled the Tax Cut and Jobs Act of 2017. It's the most far-reaching and complex tax reform since 1986. It impacts nearly every person and every business. Many people will see a net positive to their bottom line, and yet some will have trouble interpreting because the rules and there will be revised in the future. Most individual changes are temporary and will expire after 2025. As of right now, business-related changes do not expire. It adds an estimated $1.8 trillion to the national deficit, and like most things, it will probably go up from there. It wasn't passed with bipartisan support, unlike previous big tax revisions. And as with any law, the act is subject to possible revisions in the future, which adds another level of uncertainty. Indeed, future political and electoral shifts could significantly change the law going forward. As we look at more than 20 significant changes to the code, we've organized those changes into 4 keys that should make the overall message of the presentation more understandable. Our first is about the loss of many well-known, perhaps even beloved deductions. Now, this is going to be the hardest part for most of you. A lot of the deductions, as you're about to see as we get into these slides, that you're used to using, unfortunately, are gone. So hang tight and we'll get through all of them. Our second is about the unique situation faced by many residents of certain states. The third is about family issues and taxes. And our fourth is about some key important changes to the tax rules for businesses, especially small businesses. So let's go ahead and start with number 1. Tax deductions you counted on in the past may have been eliminated or changed. So you'll need to understand the impact of the new rules. In our first section, we're going to cover 7 items that you should know about the new deduction and withholding rules. Now, the first is your tax rate likely drops by 2 to 4%. Now, this is really interesting because I'm self-employed. So I do my own taxes and I file my own estimate. So as I was finalizing my estimated taxes for the fourth quarter, I was looking backwards at last year's and comparing to this year's. And sure enough, about 2 to 4% reduction in my federal taxes is what I saw. So I'll assume that you should see the same. Now, 4 out of every 5 taxpayers can expect a tax reduction, which is really good. The estimated annual savings is approximately $1,600. The highest tax bracket is lowered from 39.6% to 37%, so higher income earners will see more of a reduction than lower earners. You may have more money to spend, save, or invest depending on your situation. So there are still 7 tax brackets, and you can see here we've got the single ones on the left, 2017 compared to current law, and for those of you who are married, we have the 2017 and the current laws on the right. But do be aware the income ranges have changed, and you can see that. So let's take a look at the 25% bracket for those who are single. You see it ran from $38,701 to $93,700, and you can see now it's been reduced to 22. The $38,701 is the same, but the $93,700 has been reduced to $82,500, and that is been slightly changed for those who are married. You can see under the 25% bracket, it went from $77,401 to $156,150, and now it runs from $77,401 to $165,000. So as a result, most employees should mostly be seeing a positive change in their paychecks, although specific amounts will vary. New tax tables reflect the repeal of personal exemptions, changes in tax brackets, and the increase in the standard deduction, which we'll discuss in a second. So be sure you're having the right amount withheld, especially if you purposely plan for a rebate each year. And the IRS believes there will be further changes in the tables in 2019. What they are, we don't know at this time. So the first question to ask yourself or your CPA or tax preparer, as the situation may be, is are you withholding the correct amount given the new tax brackets? Now, if you do your own taxes, this is a tough question, so I put a link on the slide for the IRS website. So you can go to https www.irs.gov/individuals/IRS-withholding-calculator, and you can access the tax withholding calculators directly from the IRS. Now our next item, if you don't already, you'll likely start taking the new standard deduction. A standard deduction is the specific dollar amount subtracted from the taxpayer's income before income tax is applied. According to the Tax Foundation, 68.5% of all households took a standard deduction in 2016. But under the new tax law, it's expected that over 90% of Americans will be taking the higher standard deduction according to the Treasury Department. Most, but not all, are expected to be better off with the increased standard deduction. So let's take a look at that. Here are your new standard deductions. If you're single, it goes from $6,350 to $12,000, and if you're married, it goes from $12,700 to $24,000. Now this sounds really good, and it is, but do keep in mind the new tax law eliminates the personal exemption of $4,050, which means the large increase in the standard deduction won't be quite that large for some families. And this is one of the first areas that many people need to be aware of. And a lot of people are excited about the increase in standard deduction, but without the personal exemption, it's not quite as big as it appears. But what I really think is going to happen is that many people are going to be taking the standard deduction going forward, and they're no longer going to be itemizing. All right, so let's take a look at the next slide. Now here's an example of the standard deduction change. Jane Doe and John Doe are married, have 2 children, and both work with a combined salary of $71,000 per year. They don't itemize, but they take the standard deduction. They contribute 1/10 of their joint income to a 401k plan. Under the previous law, the standard deduction and personal exemptions bring their taxable income to $35,000. They also benefit from the child tax credit, bringing the family's total federal taxes to $2,317. Do note this amount does not include payroll taxes that are also taken out of their paychecks. Under the new tax plan, they have more taxable income, $39,900, as a result of doubling the standard deduction for a married couple while doing away with the personal exemptions. But the tax bracket they're in goes down from 15% to 12%. The child tax credit, which we'll cover in a little bit, also doubles, which reduces their federal tax liability to just $407. Thus, the family saves $1,910 in federal income taxes. So the next question we should all consider is, how do I itemize deductions now that the personal exemption is eliminated and the standard deduction is increased? And I'll give you some tips on that as we go through, because it's going to be difficult for people to itemize going forward. And there's some ways that you might be able to, not every year, but you might be able to. But before we get into that, let's take a look at the alternative minimum tax. Now, our third item in this area has to do with something called the alternative minimum tax, aka AMT, which was created to ensure taxpayers with many itemized deductions still end up paying some taxes. As you can see our definition there, and note that the last sentence, if you're hit with the AMT, you pay your regular lower tax plus the AMT difference. Now in the past, that has applied to a lot of people, and believe me, it was a big surprise for anyone who finds themselves in it. But now you're less likely to pay the alternative minimum tax, which is a really good thing. The Act increases the exemption amount so fewer taxpayers are subject to the AMT. You can see the higher amounts there. According to the Tax Foundation, 10.3 million households were subject to the AMT in 2015, which mainly affected those who live in a high tax state with a household income between $200,000 to $500,000. It is important to note the increased standard deduction means many households won't itemize deductions and therefore cannot get hit with the AMT. That will mean more money in the pockets of high income earners, and while some still may owe the AMT, they probably will owe less than in previous years, which they will be very happy about. Now, for high income earners, AMT is not going away. Certain actions like exercising stock options may trigger the alternative minimum tax. So it may be a good idea to talk with your accountant and your financial advisor about delaying the exercise of any stock options to avoid increasing your tax bill and therefore being subject to the AMT. Stock options could be exercised over a series of different tax years to minimize the effect against the AMT. The AMT tends to disproportionately affect those with large families. So in fact, families with 2 children are nearly 3 times as likely to pay the AMT compared to those who have no children. But again, keep in mind, if you're not itemizing, it's not a problem. Families with 3 or more children are almost 4 times as likely to pay the AMT than those without children, according to the Tax Policy Center. Therefore, larger families will likely keep additional tax savings. So a question to ask yourself or your CPA or tax preparer, if you have been subject to the AMT, will I be subject to the alternative minimum tax? And if I am, how can I minimize its impact? All right. So the next section we're going to jump into is out-of-pocket medical. And this is a big source of write-offs for a lot of people. So let's take a look. So our fourth item in this area relates to how much you pay for out-of-pocket health care in 2018 only. Again, in 2018 only. Every dollar spent on out-of-pocket health care beyond 7.5% of your adjusted gross income, or AGI, is deducted at the individual's tax rate. In 2018, the floor to deduct medical expenses for an AGI of $50,000 is $3,750. That floor will be increasing to 10% or $5,000 in 2019. The 7.5% floor benefits those with low income and high medical expenses. This benefit is not just limited for people who are very ill or have significant medical expenses, but many individuals with large insurance premiums paid with after-tax dollars or large deductibles can also take advantage of this deduction. Here are the details. The limit for deducting medical and dental expenses in 2018 drops to 7.5% of your adjusted gross income, but it goes back to 10% of your adjusted gross income in 2019. So to take advantage of the larger standard deduction by perhaps claiming the standard deduction in 1 year and then prepaying medical expenses in the next year, which will enable you to take advantage of the higher itemized deductions in an alternate year. Now, with the fact that 2018 is now in the rearview mirror, at least I presume for most of us, there's really nothing you can do going backwards to bunching deductions or doing some other tricks. But keep in mind going forward, we're going to give you some tips on how to manage that. All right, let's see, where are we? Next slide, there we go. Okay, on to things that are being eliminated. Our fifth item in this group has to do with miscellaneous itemized deductions. And with the new standard deduction and elimination of personal exemptions, Congress also decided to end many favored miscellaneous deductions. They are just no longer allowed. I mean, they're gone. For example, in the past, you could deduct moving expenses, home office expenses, investment management fees, tax preparation fees, professional dues, and casualty losses in some instances, but only if they were at least 2% of your adjusted gross income. Now you can't. These deductions are gone. They're no longer permitted. So with that, the question you should ask yourself is which deductions are still available to me, or are there any? Will I just be taking the standard deduction going forward? Our sixth item has to do with inflation and how the new tax rules, the tax brackets, credits, and deductions. Now, they won't entirely keep up with inflation and how that impacts your tax bill over time. Now, some would say there's a hidden tax hike in the new rules, and they'd be right, because this is what's called tax bracket creep. Now, you've probably heard the Consumer Price Index, or the CPI, which is used to measure inflation. It tracks the prices of a basket of goods and services and is calculated by taking price changes for each item in the basket of goods and averaging them. The new law uses something called the chained CPI, which tracks the prices and goods of services, but adjusts for changes in purchases as consumers substitute cheaper products and services for more expensive ones. So under the new legislation, marginal personal tax rates, tax credits, and the standard deduction are now indexed to inflation using the changed consumer price index, which measures the growth in the cost of living more slowly than the old tax law that used the more traditional consumer price index. So what does that mean to you? Well, linking tax brackets to the changed CPI means taxpayers will likely move more quickly into higher tax brackets as their income rises, but the tax credits they receive in standard deduction they will take will rise more slowly. So you might pay more taxes because your tax rate won't grow at the same rate as your income, but essentially this is a tax increase over the long run and will require you to think more carefully about how you invest your money in the most tax efficient way possible. The changed CPI provision does not expire. So here's another question for your CPA or tax preparer. Do I understand tax bracket creep and how to plan for greater tax efficiency, especially as I prepare for retirement? Now the good news is you can deduct more of your donations to charitable organizations. So our final item is about deductions and tax brackets. The increased standard deduction means families won't itemize their charitable contributions, but high income earners may still continue to itemize, and they can now make a deductible or cash contribution to public charities up to 60% of their adjusted gross income, a 10% increase over the previous law. This means that nonprofits who are already faced with declines in itemized donations will be seeking bigger donors who can now donate a higher percentage of their adjusted gross income to charity. And you may also want to consider other charitable giving strategies. For instance, instead of donating cash to charity, it may be advantageous to donate appreciated stock. Now, do keep in mind this would be stock in an after-tax account. The strategy tends to work best when stocks are high and have appreciated and they are owned for more than a year. You can take a deduction for the market value on the day you donate the security. Another benefit is you may be able to avoid capital gains taxes, which you would have to pay if you sold the stock yourself and gave the proceeds to charity. You can deduct the fair market value if you held the stock for more than a year. But unfortunately, if you've held the stock for less than a year, your deduction is limited to your cost basis. So given the dramatic increase in the stock market in 2017, well, it may be a good time to rebalance your portfolio and donate any highly appreciated stock. You'll need to contact your brokerage firm about donating stock, as usually they require specific paperwork. Another way to look at it is through a donor-advised fund, which allows donors to make charitable contributions to a public charity and receive an immediate tax benefit. Donations can include up to 50% of your adjusted gross income for cash and up to 30% for securities such as stocks and bonds. You can also transfer shares to a donor-advised fund when the value reaches a specific amount. So what you're doing here is making a contribution in 1 year and getting the deduction in another year, but deploy those donations over a period of several years, separating deductions from donations. It's just another way of approaching the problem. Taxpayers can also make qualified charitable contribution to a charity, which gives a tax benefit for charitable giving. The law allows you to contribute money directly from your IRA to a charity if you are at least age 70 and a half. A qualified charitable contribution is particularly useful if you are still working or have a pension and do not need the additional income. It is also helpful for those who are claiming a standard deduction but want to get a benefit for their charitable contributions. With any of these complex charitable donation strategies, you absolutely want to seek tax and legal advice before doing them. So, the next question to ask yourself, if you are donating money to a charity, should I review my charitable giving strategies in the light of the new tax law? All right, so we're doing really good. So now we're going to get into something called bunching and how to perhaps push deductions into 1 year because you can't deduct them every year. So let's take a look at how that works. Now, before we leave our discussion of how deductions and brackets have changed in the new law, it's worth looking at one tax insight that may hold some promise for some of you, especially as we get ready to talk in a second about what has changed with the loss of the deductibility of state and local taxes. It's called bunching deductions. What that means is that you would take the standard deduction in 1 year and then itemize your bunch deductions in the next year, which would entail prepaying such things as real estate taxes, mortgage payments, medical expenses, student loans, and future charitable contributions. Now, this strategy will enable you to take advantage of the higher itemized deduction in alternate years. Of course, the challenge is you'll need to write a check for those expenses in the current year. So again, consult your CPA or tax preparer before you do that. Tonight's presentation was brought to you by Portfolio Shield. Portfolio Shield is a unique investment strategy that has the potential for higher returns for less risk. Less risk is measured by Morningstar current and back-tested statistics over a 3, 5, 10, and 15-year period, including, but not limited to, beta, Sharpe ratio, and standard deviation. Based on current and back-tested returns by Morningstar since November 2003, Portfolio Shield has returned 384.3% gross of advisory and transaction fees compared to the S&P 500, which returned 125.5% over the same period. How does your portfolio compare to Portfolio Shield? For more information, point your browser to taxclass.portfolioshield.net. All right, now we're going to jump into something that many of you are not going to want to hear about, but what you need to know. It's called the changes in the state and local tax deduction, or the SALT deduction. So let's dive right into that. Now, where you live makes a big difference in how you're affected by the new rules on deducting state and local taxes. Oops, there we go. So let's take a look at two important ideas about taxes and home ownership. And here's the first one. Homeowners in high tax states lose their ability to fully deduct state and local taxes. The SALT deduction has been around since the modern introduction of the federal income tax law in 1913. Pretty impressive. It has allowed for an unlimited deduction of state, county, school, and municipal taxes to avoid being taxed twice on the same income and to promote homeownership. Now, deductibility of state and local taxes is capped at $10,000. Reducing the so-called SALT deductions will be felt mostly in California, Illinois, Maryland, Massachusetts, New Jersey, New York, and Connecticut, states that account for more than half the value of these deductions. Some states encourage their residents to prepay their 2018 property tax before December 31st, 2017, so they could claim those deductions. The IRS indicated, however, that people who did prepay their property taxes needed to have their properties assessed by local authorities in 2017 to qualify for the prepayment. And I can tell you, many people did not do that. This is where bunching deductions may be a strategy for some. So high tax states don't want their constituents to be burdened by these changes and are contemplating some creative solutions. Now, just as of publication, I am unaware of any changes in the California law, which is where I live. Make sure you ask your financial advisor and accountant if there are any state-specific plans in your area. Keep watching your state governments for new ways to reduce the sting of losing 100% deductibility of SALT. Now, if you do live in a high-tax state, you can consider going to your financial advisor to see how you can revise your financial plan to adjust for a change in cash flow. How will this change impact your expenses? Now, of course, you may want to think about moving, but that is not that easy. If you can work remotely or retire, you may want to take a look at Texas, Arizona, or even Florida. So a question to ask your CPA or tax preparer, or yourself if you do your own taxes, is can I still deduct my full state and local taxes? And is my state pursuing any alternative SALT deduction plans? This is a big, big issue. And on that lines, let's talk about mortgage interest deduction. You may not be able to fully deduct your mortgage interest anymore. And this is a major change to the way Americans deduct interest on their mortgages and home equity loans. Existing mortgages are grandfathered to the extent of the original amount of the loan, but not over $1 million, and should not be increased in a refinance if it exceeds the $750,000 limit. If the new debt is over $750,000, the additional mortgage interest will not be deductible. Another major change is that home equity loan interest is not deductible unless it is used in connection with home acquisition or improvement. And these loans are not grandfathered in. This is real key. These are not grandfathered. So if you took out a home equity loan 2 years ago and used it to pay for college tuition, family vacation, or anything except home acquisition or improvement, it's no longer deductible. So some think of this could cause housing prices to fall. Maybe, but it may be an advantage in some overpriced housing markets. So the new tax rules around home ownership have changed. For certain people, it might cause you to at least evaluate the relative benefits of home ownership in your specific case. So when considering the home ownership costs, some key considerations. The con? You can't deduct a new mortgage over $750,000 and your property tax deduction is limited. Pro? Of course, home ownership plays a strong role in building wealth for mortgage payers and owners. But the new tax rules will put a crimp in the finances of some second homeowners. You'll want to consider future costs under the new tax laws and whether you need or want to continue owning that second home. And of course, if you're retired, semi-retired, or on the course to retire in a few years, you may want to consider downsizing or moving to a low tax state. So a question that comes up that you should ask your CPA or your tax preparer is, should I accelerate paying off my mortgage or consider moving to a lower tax state? Tonight's presentation was brought to you by Portfolio Shield. Portfolio Shield is a unique investment strategy that has the potential for higher returns for less risk. Less risk is measured by Morningstar current and back-tested risk statistics over a 3, 5, 10, and 15-year period, including but not limited to beta, Sharpe ratio, and standard deviation. Based on current and back-tested data by Morningstar over the past 10 years, Portfolio Shield has 19% less volatility compared to the S&P 500 as shown by the beta, and has a higher historical risk-adjusted performance than the S&P 500 as shown by the Sharpe ratio, with cumulative returns more than 1.5 times the S&P 500, not including any advisory or transaction fees. How does your portfolio compare to Portfolio Shield? For more information, point your browser to taxclass.portfolioshield.net. All right, so now we're about to move into the third key, which is going to be family-related tax stuff. So let's jump right back in. So our third key is family-related tax rule changes regarding children, education, high-earning couples, divorce, retirement, and estate planning that may need your attention. Oops. So this time, let's take a look at 6 family-related tax rule changes. Now, our first item is very straightforward. Your child tax credit doubles from $2,000 or doubles to $2,000 per child, and you may be eligible for this refundable credit. So the child tax credit was originally designed to help working families with the cost of raising their children. Prior to the new tax law, the child care credit was $1,000 and only a portion of that amount was refundable. Taxpayers could only claim a refund on a percentage of income over $3,000, which mainly benefited lower income households. The credit phased out when the taxpayer's adjusted gross income exceeded $75,000 for single filers and $110,000 for married couples filing jointly. Now taxpayers can claim up to $2,000 per each child under the age of 17. And the credit doesn't phase out until a single filer's income is $200,000 or a married couple filing jointly is $400,000. This change in the phase-out limit will allow more middle and upper income families to claim the credit. Up to $1,400 is refundable, meaning a taxpayer can receive money back even if no taxes are owed. This is beneficial for all income levels, especially those who do not owe any taxes. This will put more money in the pockets of most families. So here's another question to ask your CPA or tax preparer. Am I eligible for the expanded tax credit, and how will we use those additional funds? Now, 529 plans were also impacted under the new tax law because they can now be used for K-12 education. So 529 plans were created in 1996 as a vehicle to save for higher education and are very popular with middle and upper income families. Most states offer these plans, but they typically offer limited investment options. These plans have become so popular that according to the College Savings Plan Networks, they have $275 billion in assets as of 2016. Now, 529 plans are no longer limited to post-secondary education, allowing a $10,000 annual distribution to pay for K-12 private or parochial school. Many states offer residents a tax break on 529 contributions to their state plan. However, those in California, none such exist. The new limit on state and local tax deductions will most likely make these accounts more appealing than ever if your state allows for a tax break. Again, California, where I'm at, does not. Also, you can roll a 529 plan into a 529 ABLE account, which provides tax advantages to people under the age of 26 who are blind or disabled without limiting their ability to take Medicaid and supplemental security income benefits. Note that after the death of a beneficiary, funds in an ABLE account can go to the state to repay Medicaid benefits if they were receiving those monies. The designated beneficiary of the 529 plan must already own an ABLE account. The increased flexibility of 529 accounts is a clear victory for private schools. Almost 36 states already offer an income tax deduction or credit for a contribution. Notably, California is not one of them. One possible disadvantage is that private schools may want to know about the existence of 529 plans when making any financial aid decisions. Given this drawback, it is more crucial than ever to discuss contributions with your financial advisor. Also, you will need to consider that withdrawing money from a 529 to pay for private school shrinks the time your assets can compound tax-free. Of course, to take advantage of a 529 plan, establish the account as soon as possible and research the plans that are available to you. So a question to ask your CPA or tax preparer: am I paying for private school tuition that could be funded with a 529 plan? And again, those plans are very beneficial and work out really well for lots of families who are able to use them. Now we're going to get into our next section, which has to do with divorce and alimony. So if that's your situation, well, let's take a look and see how the new law is going to impact you. Now, for our third family-related item, this is not normally a happy situation, but starting in 2019, there are new rules for how alimony is taxed. Alimony is no longer a deductible expense for the payer, nor is it considered income to the payee. Before the new law, and for the last 75 years, alimony was a deductible expense for the payer and reportable income for the recipient. Oops, let me slip that slide back over there so you can see it. There you go. Sorry about that. Now that has been totally turned around for divorcees after 2018. So I'll leave that slide up there for a moment so you can catch up. All right, let's go on to the next one. So just to give you an idea of the number of people this hurts, in 2015, 600,000 tax filers deducted $12.3 billion for alimony payments. So this clearly is an issue that will affect many Americans, as the divorce rate among Americans has hovered around 50% for quite a while. Now, some critics of the new tax code argue that the change to the way alimony is handled gives married couples an advantage. The Ways and Means Committee, which assists in writing the tax code, called the previous alimony deduction a divorce subsidy. The committee noted in November 2017 that a divorced couple can often achieve a better tax result for payments between them than a married couple can. So consider tax implications of divorcing. It means your attorney may need to do more with less. Could be less money supporting two households. You may want to consider property settlements in lieu of alimony. You'll need to review your financial plan to confirm enough assets and income are available. And also, prenuptial agreements may have assumed the tax deduction. So when in doubt, absolutely seek the advice of a tax professional. There's just absolutely no question that you'll want to do that in this case. And a question for your divorce attorney, if you have one, or mediator, depending on your situation, is do they understand the new tax treatments for alimony and how that may affect your situation? I mean, this is absolutely critical that if you're going down this path, or you know someone that is, that their attorney or mediator understands these laws, because this is going to have a long-lasting effect on their divorce. All right, back to the slides. Let's talk about Roth conversions. And our fourth item relates to retirement planning and Roth IRAs. Now, Roth IRAs are a retirement account for post-tax income up to a specified amount each year. All withdrawals after 59.5 are tax-free if the 5-year holding period has passed. Unlike IRAs, there is no required minimum distribution for Roth IRAs. A Roth can be a very powerful tool to help you save for retirement. In fact, now more than ever may be a good time to convert your pre-tax dollars in your traditional IRA to a Roth IRA, since your tax bracket may have fallen due to the change in income brackets. Prior to the Tax Act, if you converted an IRA into a Roth IRA and then the market went down, or maybe you changed your mind about a conversion because of cash flow issues or any other reason, you could recharacterize your Roth back to an IRA before October 15th of the following year. Now, as a rule of thumb, many people requested their conversions early in the year because they knew it could be reversed. Now you cannot change a Roth back to an IRA ever. Once it is converted, there are no more do-overs, which is likely why you want to do your conversions in October or later to make sure that you want to keep them. But even though this change is coming, Roths are still a great retirement planning tool. Making smaller conversions over different tax years will eliminate doing a large tax conversion in one year and the difficulties connected with tight cash flow near the tax filing date, or if the market pulls back, decreasing the value of the account. Roth IRAs are still an attractive retirement account for many reasons, including the ability to take qualified tax-free withdrawals and the availability to make contributions at any age as long as you have earned income. In addition, a taxpayer can avoid the required minimum distributions with a Roth IRA, which is a huge benefit. So consider smaller conversions over several tax years. Consider future cash flow carefully as your ability to pay the tax bill when it comes due. Consider the potential for a market slide when deciding whether to convert. And consider timing the conversion for later in the year instead of earlier in the year. Now, one strategy to consider is diversify between traditional IRAs and Roth IRAs whenever possible, because future tax laws remain unknown. Traditional IRAs may give you more disposable retirement income if future tax rates are lower, whereas Roth IRA may benefit you if there are higher future taxes because you don't have to pay taxes on qualified Roth distributions. According to a study recently by the Wall Street Journal, savers who plan to retire in 30 years may provide themselves with a hedge against changes in the tax code if they split their contributions between pre-tax and Roth accounts. So a good question to ask your CPA or tax preparer if you are contributing to a traditional or Roth IRA is, am I saving my money in the right one? So that is a great question. Along those lines is our fifth family-related item, is you may now have a longer period to roll over or repay outstanding loans against your retirement plan. Many plan participants may not be aware that when they leave an employer and have an outstanding loan balance, that loan can be defaulted on and treated as a taxable distribution, which would entail a 10% penalty if you're under the age of 55. In the past, participants had the option to repay the plan loan or do a tax-free rollover of the balance within 60 days, so the loan was not treated as a taxable event. The new Tax Act extends the time frame you have to roll over the loan so a taxable distribution doesn't take place. This is a positive change, as many unemployed participants didn't have the funds available to do a rollover within 60 days. So here's another question. If I leave my job, do I have any loans from my retirement plan that need to be repaid or rolled over? Our sixth item has to do with the estate plan exemption, and it doubles. The House GOP legislation proposed a total repeal of estate taxes, but it didn't happen. While the Tax Act doesn't go that far, it does double the unified estate and gift tax exemption amounts from their current levels, which raises the scheduled 2018 exemption of $5.6 million into an $11.2 million individual estate tax exemption and a $22.4 million exemption for married couples if you pass away after December 31st, 2017. And I suppose if you did, you probably wouldn't be watching this now. A step up in basis remains, as does the top 40% tax rate on gifts and estates, as well as the existing rules on generation skipping taxes. But it wasn't that long ago that people with estates under $1 million had to worry about the estate tax, so the number of wills and trusts that need to be reviewed and revised in light of the changes in the law is enormous. Many of these documents have formula clauses tied to the amount of the exclusion, which could now result in unintended estate dispositions. Many of these estate plans should be reviewed in light of the Tax Act. And the federal estate tax is not the only reason for doing some estate planning. There are state taxes that apply now in many situations. There are family circumstances to consider in determining how much to leave beneficiaries and in what manner. So trusts are important to control the disposition of assets even if the estate taxes are no longer a factor. So for people under $22.4 million in assets, which is, 99.92% of people, it is still important that their estates are distributed to the right beneficiaries in the right way. So according to the Center on Budget and Policy Priorities, which 2 out of every 1,000 estates owed federal estate tax in 2017, which means that 99.8% of estates owed no taxes at all. So with the new estate tax exemptions, those numbers will be approximately 0.8%, or 8 out of every 10,000 estates will now owe the federal estate tax. But this doesn't mean you should forget about your will or your trust. The new rules applied to old wills and trusts could trigger unintended consequences. So be sure to check your wills and trusts with your estate planning attorney to ensure their formulas are still applicable or need to be changed. Some states under the exemption levels may no longer need life insurance policies to pay federal estate taxes, but of course, be aware you may still owe state level estate taxes. Those are not changing in the new federal tax law. And how you can stay ahead of these massive estate law changes? Well, planning remains critical largely for closely held businesses with a net worth significantly greater than the exemption amounts. By being proactive in re-examining your wills, trusts, and portfolios with your estate planning attorney and financial advisor, you can maybe avoid some of these problems. Now, keep in mind, these are tried and true strategies, so estate planning is not just about tax issues, and that a large exemption does not solve all estate planning issues. Estate planning remains complex and critical for all families, so keep in mind, seek the advice of your attorney and your tax professional and your financial advisor. So a question to ask is, if you have purchased a life insurance policy to cover your estate taxes, do you now still need that policy, or can you get rid of it? Tonight's presentation was brought to you by Portfolio Shield. Portfolio Shield is a unique investment strategy that has the potential for higher returns for less risk. Less risk is measured by Morningstar current and back-tested risk statistics over a 3, 5, 10, and 15-year period, including, but not limited to, beta, Sharpe ratio, and standard deviation. Based on actual Morningstar back-tested data over the past 15 years, Portfolio Shield has outperformed the S&P 500 over a 1, 3, 5, 10, and 15-year period, gross of advisory or transaction fees. How's your portfolio compared to Portfolio Shield? For more information, point your browser to taxclass.portfolioshield.net. All right, so now we're going to get into a really neat part for those of you who own a small business or planning to own a small business, because there's some really neat stuff that's going on here. So let's take a look at those. So here we are with our final key. All businesses face new opportunities regarding how they pay taxes and what deductions and depreciation they can claim. Now, what we said about individuals needing to understand the new tax rules and get good tax advice applies to businesses too. The part of the tax code that covers business entities is expansive. Any business owner, whether he or she has a small, medium, or large entity, is going to want to have serious talks about the new rules and how it impacts his or her organization. A business tax presentation could go on for a full day, believe it or not, but some of you own or run a business, and I want to just touch quickly on a few items about the new tax law that you should know to explore more carefully. Here's our first one. Businesses will now pay a much lower tax rate in the past. Top corporate tax rate is 21%, and it used to be 39.6%. The U.S. did have some of the highest corporate taxes in the world, but after deductions, they really were right in the middle of the pack. Now corporate taxes are going to be at one of the lowest levels since 1939. Some other good news, the corporate alternative minimum tax is gone. Now the belief is that lower taxes should spur increased business investment, but obviously we'll see how that shakes out in the years that come. And here's one difference between the business and personal changes in the tax code. Remember, the new tax rules for individuals are set to expire after 2025, but for businesses, there is no such expiration, and they are permanent for the time being. Our next item is good news. Small business owners get a 20% deduction for pass-through income. Pass-through may be a phrase that's new to you, so here's its definition. Individual business owners may pay taxes on their firm's income on their personal income tax return. So prior to the new tax law, small business owners usually pay taxes on their individual tax rates up to 39.6%. Now owners will be allowed to take a 20% deduction for qualified business income, and those individuals will only be taxed on 80% of their pass-through income. Combined with the new 37% top individual tax rate, the top tax rate for eligible pass-through business income is 29.6%. Most small businesses should see some sort of relief in their taxes, which is really good news. Now, some details to note here. Roughly 92% of private businesses in the United States are organized as pass-throughs. Pass-through businesses may include sole proprietorships, partnerships, limited liability companies, and S corporations. The deduction phases out for highly compensated professionals such as dentists, lawyers, and investment managers, beginning at incomes of $157,500 for single filers and $315,000 for joint filers. The deduction is unavailable when total income reaches $207,500 for single filers or $415,000 for joint filers. So a couple with a small business that has less than $315,000 of total income could pay $20,000 in less taxes. But of course, you absolutely want to seek advice from your tax professional. In fact, recently I was meeting with one of my clients who owns a small business, and he was asking me about the structure of his company. And I said, hey, under the new tax law, you might be in a better situation if you change how your company is structured. And so I encouraged him to go meet with his CPA and his attorney to find out if he even needed to keep his structure the way it is or to change it so he could get the maximum benefit under the new tax laws. All right. The other good benefit for small businesses, as you know, once you ask yourself the question is, can I take advantage of this 20% deduction? And hopefully you can if you own it. But again, you may want to consider changing your business structure. So the other good question to ask is, small businesses can now quickly depreciate certain expenses faster than they could before. Now this is technical, but it's going to be pretty important to some of you. The Tax Act gives business owners greater incentive to invest in equipment and other assets. The cap on expensing business assets has increased from $500,000 to $1 million. So small business owners will absolutely want to seek accounting and legal advice before they do any of this. So again, along the lines of our other question, what business equipment purchases or improvements are you contemplating that now may be able to receive a more generous depreciation? So let's take a recap now and see where we've been. We've seen that many deductions have been eliminated or changed. And when we look at what the new tax rules might mean for those who live in high tax states. We went over a range of family-related tax rules that may need your attention, and we looked at some rules relating to businesses. One additional repeated note for emphasis: the new tax rules for on a personal basis expire after 2025, while the business rules do not. We started by asking you to keep these questions in mind throughout the presentation. And along the way, as we looked at the underlying rule changes for each of these 4 keys, we asked you to consider some specific questions. It's your answer to those questions that will drive your next step actions. That's why I want to encourage you to do that and take action when you sit down and meet with your CPA or tax preparer between now and April 15th. And taking action means you should seek professional help from your tax advisor. Ensure that you understand how all the new rules impact you, and start by building your tax and investment review plan now. As we've seen, the new tax rules have introduced a range of uncertainty about their full impact. Believe me, there are even CPAs that are not fully abreast on these, but they're getting there very, very quickly. Everyone's taxes are different, and at least temporarily, you may have more income to save and invest. There are new issues and challenges to address in your family financial plan and how to structure and run your business. All of these items you'd ultimately address with your CPA or tax preparer. Now, if you enjoyed tonight's presentation, be sure to like and follow me on Facebook, as we're planning on doing more free online classes. And if you're interested in what's going on in the stock market and the economy, every day I post a daily market brief so you can keep apprised on what's going on in the world. Tonight's presentation was brought to you by Portfolio Shield. Portfolio Shield is a unique investment strategy that has higher returns for less risk. Less risk is measured by Morningstar current and back-tested risk statistics over a 3, 5, 10, and 15-year period, including, but not limited to, beta, Sharpe ratio, and standard deviation. Based on actual data and Morningstar back-tested data over the past 14 years, Portfolio Shield has outperformed the S&P 500 in 11 out of the past 14 years, gross of advisory or transaction fees. How does your portfolio compare to Portfolio Shield? For more information, point your browser to taxclass.portfolioshield.net. All right, so with that, I'm going to leave my contact information up here for a moment. So if you do have questions for me, you can reach me by phone, email, or you can go to my website for more information. So I want to thank you all for joining us tonight. And again, just so you know, you can rewind any part of this class and it will be available on replay for the next 48 hours. I am planning on offering this class again over the next several weeks. So if you know people that can benefit from it, be sure to like my page on Facebook. And when you see the event show up, please share it with your friends and family so they can enjoy the benefits of it as well. So again, I want to thank you for spending the last hour with me, and I look forward to seeing you in a future class. Bye now.